Hey, what's up, everybody? Anthony and Cory here.
Hello.
Hello. Just finished wrapping up the third episode of the podcast. What do you think, Cory?
That's pretty good. Short, sweet, for sure. A lot of good info in there.
Yeah, we had John Child, one of the managing partners here at First Equity, talking about something that a lot of people maybe have not given consideration to before, which is passive real estate investing through a fund or a syndication. And a lot of good pointers and tips in there if that's something that piques your interest.
Yeah, it was a really heavily focused on, I wouldn't say our fund, but funds like ours and investing in those in general. But there's so many different ways to passively invest in real estate out there. So I think it's a good place to start. But it's definitely, I think, something that people should really explore, and maybe instead of sticking their money in the stock market, bonds, the typical way of doing things, there's definitely a safer way to park your money.
Yeah, I mean, a lot of people are at one of two extremes. Either you don't do anything involved with real estate, or you're heavily involved and you own properties and you're doing flips. And for a lot of people who maybe have a 9 to 5 and have a lot of money in their retirement accounts that they want to put to work, it's not sensible for them to be a full-time flipper, or they just can't manage projects like that. So this is a good alternative to somebody who, like you said, might not want to be in the stock market but also doesn't have time to be a full-time investor.
Yeah. I think everyone's going to really enjoy this episode.
Yeah, so without further ado, we'll get right into it, and here's John Child, and enjoy. Welcome to episode 3 of the First Equity Funding Real Estate Podcast. As always, I'm Anthony Palmiotto with Cory Anderson, and special guest today, one of the managing partners of First Equity, aka our boss, John Child. John, thanks for coming on the show.
Thanks for having me, guys. Looking forward to it.
So I guess before we get into our topic today, which is passive real estate investing, let's talk a little bit about First Equity, because we get this question a lot. How'd you guys get into the hard money space? And you want to tell us maybe kind of where your background was and how we ended up where we are now?
Yeah, absolutely. Yeah, for sure. My background is really more of a Wall Street background, working at Morgan Stanley. Most of my career I was in equity derivatives. But the way I got involved in the mortgage space and real estate space was 10 years or so ago, and back during the mortgage crisis, I partnered up with Christian and Jared, who were the owners of First Equity Mortgage. And the way we started was we were purchasing residential, non-performing residential whole loans. So it was really an interesting space at the time. These notes were trading at really severe discounts, and these guys had approached me initially as an investor, and I was just going to put some money in to do it. And then I said, this is kind of interesting. Things got really ugly on Wall Street, and I decided to just join these guys, and we essentially started a fund with friends and family money, which came to be known as First Equity Capital.
Mm-hmm.
And so that's how we got started, really, just buying NPLs at discounts in mini bulk. From there, we ended up taking properties over, often as REO, and that's where we kind of started cutting our teeth on the straight real estate side of things, where we fix these properties up and then kind of sell them.
Right. And I think a lot of people who have worked with us don't really know that until they actually do a loan with us, that we have experience really from all sides of this, from the finance side, obviously with the Wall Street background, from the fix and flip side, you've done them yourself. So I think as a company that, some of your experience, it kind of makes us pretty well-rounded.
Yeah, you're right, Anthony. And I think the fact that we have our own construction company, that we've done a lot of fix flipping ourselves, that we've kind of bought, distressed mortgages in the secondary market and dealt with borrowers and foreclosures and bankruptcies and all those various things gives us and then the fact that we've been conventional lenders for so long really gives us, I call it like a 360-degree view, where we're kind of seeing all aspects of the business.
Sure.
And I think it's really worked out well for us. We've made a lot of the mistakes in our past life, and we've lost money on fix flips like some of our borrowers do, or are gonna, unfortunately. But it really helps us, see the business from the borrower's point of view.
Yeah, and like we have the ability, I know we've done it before, where we'll get a scope of work and we can look at it in 2 seconds, and just with our experience and knowledge, we say this is out of line or this is not what it's going to cost, and I think that provides a lot of value to borrowers.
Well, before we move forward, I was going to ask, how was the foreclosure process? How was that time?
I guess, I'll tell you, yeah. Well, back when we were doing it, it was a nightmare.
Yeah.
What happened is New Jersey's a judicial foreclosure state. So they got flooded with foreclosures, when the mortgage crisis was unfolding. So, things were just stuck in the court system it would take on average close to 2 years to foreclose on somebody. So that's one of the reasons New Jersey was trading at such a big discount. So yeah, and nowadays though it's much better for a couple of reasons. They've streamlined it a little bit, and the backlog has gotten cleared up. So now it's more like an 8 to 12 month process to do a foreclosure.
If I'm not mistaken, we're one of the biggest foreclosure states in the country, right?
Yeah, for a number of years after '08, we had one of the largest amount of foreclosures. Again, I think it's because of the fact that, well, we're a densely populated state, even though we're a smaller state, but also just that there were so many of them in the court system. Whereas in a lot of other states that are non-judicial, in other words, you don't have to go through the court system to foreclose, you can do it a lot quicker and you can
Right.
move them through the pipeline. They become, REO or get sold into investors' hands quicker and helps clear out the backlog faster.
So you started foreclosing on some of these notes, and then I guess started doing some fix and flips yourself. And I guess it was at that point you guys kind of realized that there was kind of a void in the market for what you thought would be a good outlet for hard money.
And what year was that?
Yeah, that's absolutely right. I mean, we started up an institutional relationship with the group called Javelin Capital, based out of Omaha. Not a household name in this area by any means, but we were using similar to kind of hard money, where we were paying a fairly high advance rate to our institutional partner, and then we were splitting profits. But yeah, as we were out there doing this, we started to realize, with also having our conventional lending hat on, that banks just won't lend to these type of investors on these types of properties. And for really no good reason. There was a real void in the market. Banks just don't want to lend on properties that are in disrepair and need rehab. And
Sure.
a lot of our borrowers, quite frankly, are self-employed, whether they're realtors or contractors, and they're not showing a lot of income, on the books. So banks, like, they look at it and go, hey, I don't
Right.
want I don't want to touch this. But if you really take a step back and look at it and you say, why wouldn't we lend to this guy? He's got decent credit. He's got the experience. So what if the house needs a little bit of work? These guys can do it.
Right.
And we're lending at reasonable pricing where we're compensated for the risk we're taking. And we do it at a loan to value that works for us, but also helps the investors out.
So I guess that's kind of how First Equity Funding was born. And
That was in like 2013-ish, I believe.
We for
2012.
the hard money, I don't think we were really doing until like 2015.
Okay.
So we may have been doing a few as late as that, Corey, but it would have been like really more one-off. But since we started our fund about officially launched it like 16 months ago, back in March of 17 is where things have really been kind of picking up.
and that
First Equity.
and that really segues into today's topic, which is passive real estate investing. And it seems like fix and flip has just gotten that much more popular month over month, year over year for the past 5 years. And now everybody wants to get into flipping. A lot of people learn it's not quite as easy as it sounds. It's a job, and listen, you can make a lot of money, you can do very well, but there's a lot of work involved in it. And so you want to talk about maybe how just some investors, they go from not being involved in real estate at all to thinking they have to become a flipper to make money, and there's a nice middle ground called passive investing. I mean, you think it's just the case that a lot of people don't know that there's opportunities out there somewhere in the middle?
Yeah, I think you're absolutely right. You're right. Fixed flipping is so popular these days, whether it's partly because of HGTV or things were trading at such discount. There were so many properties going back to '08. But yeah, everybody thinks they can be the next flipper, and it's a tough game. Like I said, we've done it. It's, first of all, finding the good opportunities tough, executing it, getting the work done on a timely basis at a good price. Then you got to do you have the marketing and the resale risk and all that type of stuff. So yeah, there's a lot of ways that you can get tripped up or stumble. It's not the easiest game in the world. But so yeah, I think there are other ways to get exposure to real estate and in a much more diversified way, so you don't have all your eggs in one basket. But I think what you notice, like a lot of funds out there are like these large private equity funds, and it's not easy for a regular Joe type guy that wants to put 50 or 100 grand to work. A lot of these guys have like $1 million minimum investment, things like
Right.
that. And it's really more of an institutional world, not an individual mom and pop type arrangement. But with a fund like ours, First Equity Funding, it's kind of interesting. We do a lot of the work, do all the underwriting, and create a diversified portfolio that investors can then come in and passively invest in. And obviously be pretty hands off. We're very transparent in how we lend, who we lend to, and what our portfolio looks like. And you'd have to be comfortable with that, obviously. But there's not a lot of work you can do, and you can have your money put to work in the real estate market in short-term, relatively high-yielding loan portfolio.
And I think I just read that we're now at the highest run-up of the stock market for consecutive years, like ever. I think we're on basically a 10-year bull run, right? I mean,
Yeah,
on equities. So
we had a record last year. It's been a little up and down this year.
That's a good point, because I got the question before. I've actually, I've talked about the fund to investors if they ask about it, they're interested in passive investing. and I get the, oh, what happens if the market tanks? There's that risk.
Yeah, it's a good
Let's-
question. That's the question I'd be asking as an investor, and it's probably the question I get most frequently when I'm talking to investors. And the only answer I would say to that is, of course, there's always risk, there's always exposure. But with our fund, a couple things. One, the fact that you're lending such short-term paper, so you don't have a lot of long-term exposure, should give you a little bit of comfort. So that a lot of these loans will be rolling off in a 12-month time frame. Second, we actively trade our loans in the secondary market, so we're not sitting on a really large portfolio of loans at any one time. So so if things get really dicey or ugly, we're not sitting on a 50, $100 million loan portfolio that we would then have to try to unwind into an ugly market environment. So what we do is we're pretty careful with our risk and getting loans sold off of our books. We typically keep maybe a participation or a risk piece, but it's relatively small, and they're not cross collateralized against the other loans in our portfolio. So that's my answer to that question.
And as far as selling loans off to the secondary market or trading them on the secondary market, I think you mentioned that really juices returns anyway, right? So that's really a benefit to the investor.
Yeah, that's right. I mean, we think it's prudent to take advantage of the bid in the secondary market. These large private equity funds that are looking for yield, there's a lot of interest in these type of loans. So there's no shortage of pretty large people out there, private equity, hedge fund type players that reach out to us on a regular basis that want to ask them what kind of loans we have and what they can buy from us. We whittled it down. We have 2 or 3 preferred partners that we work with closely, that we think do the best pricing for us, so on and so forth. But yeah, by doing that, we can kind of reinvest our capital. We free up capital again. We originate more loans, we sell out of them. We leave a little bit on the table, but we dramatically reduce our risk, and we can create a nice return for our fund investors.
And one thing that is particularly appealing to investing in a fund that's focused on real estate, especially one where, say it's on a smaller scale, maybe like First Equity or somebody who's actually hands-on with borrowers, is there seems to be a little bit more control, right? We're the ones actually dictating who we're lending to and what markets we're lending, whereas if you're buying equities or you just have your money in your 401k, you really don't have any control. I mean, do you think that's an advantage to maybe investing in this type of fund where, you're talking to the managing partner of First Equity, we're the ones calling the shots in terms of where the money's going?
Yeah, that's absolutely right. And to Cory's point earlier, what if things get a little dicey? Then we can just fairly quickly just stop originating entirely, curtail it, change our pricing, change our leverage. There's a lot of things we can do to manage the risk. And that's what my focus is, and Mark Presto, our Director of Finance. So we're constantly looking at our loan portfolio and looking at the pricing metrics, the diversification with borrowers and geography and so on and so forth. But yes, we have that control. We can decide who we lend to, where we lend. Whenever we're doing a loan, we're always looking at the local real estate dynamics. Is it in a declining market, increasing market, things of that nature. But yeah, you have that control, and that's huge. And yeah, and to your point, it's like this is a nice way to diversify away from just traditional stock and bond markets. And this is not that closely correlated with the daily or in monthly moves in those markets. Obviously, we're tied to the broader economy, but so yeah, it's a really good way to diversify. And maybe we can get into this later, but the fact that you can actually invest your IRA money, self-direct some people that have a retirement account into an investment like this. We're an approved self-directed IRA investment.
And
No, I was going to say, talk about risk. I mean, what is more risky than betting on a 10-year bull run that's going to keep going up?
And that's kind of what I was getting at before, is like we've done really good in the stock market for the past 10 years, and I would have imagined that's going to change at some point. I mean, obviously, as we know, the markets don't go straight up forever, so to be in something else aside from just equities, I think might be appealing to a lot of people.
Yeah, that's exactly right. If you look at the return you get in the stock market or bond market, to really get the kind of yield you're getting in this type of an investment, you have to really go out the risk curve and be in emerging markets, kind of high yield, junk debt,
bonds, right?
or speculative stock. Not S&P 500 or really Dow 30 type stock. So the way and the relative volatility is certainly what we've seen since the fund started. There's been very little volatility, luckily, because we had so few defaults or delinquencies. So I just think it's an interesting way to get a nice return. We target a 12 to 15% return in the fund. And I know other funds like us have similar yield metrics. We're outperforming a little bit. In our first 12 months, we did about a 19% plus return. So on a risk-adjusted basis, I think that's a really interesting return on secured loans.
And not only that, I mean, I feel like investors get frustrated sometimes with lenders But I mean, there's a method to the madness. Correct me if I'm wrong, but in this space, I mean, it's a really high focus on experience and also like after repair value margins, and it's a lot of thought goes into these investments.
Right.
It's not
Yeah.
so much just putting money out there hoping, okay, hopefully they fix it and get
It's
the
a
money
very
back.
scientific and calculated lending process.
Yeah, absolutely. We have a full underwriting process. We have an underwriting committee, but yeah, we're looking at all those things. What type of experience does this person have? What's their rough credit profile? Even though, we don't underwrite to a specific credit score, we have a minimum. It's just really kind of common sense underwriting. But does this deal make sense? Can this person execute on it? And are they making enough money? Is there enough of a profit in this deal? Because it's a major risk factor for us if there's not a lot that it would increase the default risk potential. But two, we want our borrowers to make money. We
Sure.
want them to have a good experience working with us. And we don't. Last thing we want to do is lend to people that are trying to do deals super tight that either don't make any money or lose money and kind of end up having a bad taste in their mouth through no fault of ours per se. But
Yeah.
we like to try to help them vet the deal up front.
And that's
as
where
well.
that's where the experience in the office comes from. Is seeing the deal, the money multiple, saying, listen, there's just not enough profit there.
Yeah,
Sometimes.
too many. Yeah, one or two things go wrong, and all of a sudden you could be losing money here.
Yeah.
So yeah, we try to point that out, and sometimes the best loan is one that you just don't do for whatever reason.
And I know
And
we've come up against that as loan officers where maybe a different company could push a loan through because technically you can get it to fit the right boxes and make it work on paper. But I think it goes back to our experience as a company with all our 360-degree view, as you put it, of the business, that we just know this is a little bit too tight or this market's not strong enough for us to want to do this. And like you said, maybe the best loan is the one that you don't make sometimes. So I think that's something that we've done pretty well with our borrowers so far. And I think our performance has shown that.
yeah, we've been very, very fortunate. Like I said, our delinquencies are very, very small. We've never really had a full-blown default yet, knock on wood. But yeah, our loan officers, you guys, everybody does a really good job taking a long view in this space. We want to be in this space for a long time. We want to be a preferred lender in this space, and we want to be partners with our borrowers so that they keep coming back to us. So yeah, we very much look at it that way. We're not short-sighted and trying to just get a loan done or closed or whatever. So I think that's really going to help us out in the long run.
So putting maybe First Equities Fund aside, just talking more generally about passive investing, who who do you think would be an ideal person for somebody to get involved with something like that in terms of, I'm guessing it's somebody who's a full-time employee maybe who doesn't have time to do it themselves, but what should somebody be looking for if you think passive investing would be a good match for them?
Yeah, I mean, like, obviously, it starts with someone's financial position. What kind of, where are they currently invested? What kind of, capital do they have at their disposal? And what kind of real estate exposure do you have? And if you don't have a lot of real estate exposure, other than maybe the home that you live in, and you're comfortable, lending in this market, that's the kind of person that I guess we'd be looking for. Someone that wants to diversify a little
Hmm.
bit, that is comfortable being in the real estate market and is looking for a much better return on their money than they might have in, some sort of bond fund where you're getting, 3, 4, 5% or less or something like
Right.
that. And in the commercial space, you can talk more to this, Anthony, but cap rates in the commercial space are extremely tight and low.
Yeah.
Are they what, like 5, 6%? I don't even know, maybe a little
I
better
mean,
than
in
that.
parts of northern New Jersey, cap rates have gone even below 5% in certain markets, in the
Yeah.
fours. And so, if you're going to go out there and try to find deals yourself, it's my experience that it's just so difficult to find deals in today's market that a good option might be working with somebody who's a little bit more experienced and someone who's syndicating deals and raising money for those deals, because you just hitch your train to their wagon, and next thing you know, you're getting maybe a preferred return of 7 or 8%. Say in a multifamily deal, plus an average annual return of something like 10 or 11%, and all of a sudden you're not doing so bad, and you're secured by real estate as opposed to being just in the stock market. So there's a
Yeah.
lot of ways to do it passively, and sometimes it makes actually more sense to do it with somebody that's their full-time job, is
Right.
either doing hard money or buying whatever type of commercial real estate, as opposed to trying to do it yourself. And we've seen people get burned all the time, especially new investors who try to be cowboys and do it all themselves. So it's a good way to learn the business too. Maybe if you want to do fix and flips at some point
Mhm.
and you kind of just want to be involved initially, it's not a bad idea to get involved with a fund, and then start branching out and doing some of the deals yourself.
Yeah, or do a mix, right?
Yeah,
I'm going to do a couple fixed flips, but I'm also going to put some money passively into a fund that helps me diversify.
right.
And one of the things we try to do with our fund, and and you should always look at whatever fund you're looking at is, what are the exact terms of investing. What's the lockup? When can you get your money out, and things like that. And we try to make our fund appealing to an investor. It's a 1 year lockup, which is a lot of times you see more like a 2, 3 year or even more lockup of your money. And after that 1 year lockup, you can get monthly liquidity with 45 days notice. So in case whether you have kids going to college or you're
Sure.
doing active real estate investing and you want access to your money, after a 12-month time frame, you can then give us notice and withdraw some of your money out of the fund. So it gives you some level of flexibility.
And if somebody's looking to passively invest, especially in like whether it be a REIT or some type of real estate fund, is there any like couple pitfalls that I guess you'd have them look out for?
Well, you want to look really closely whether it's a REIT, what is the real estate portfolio that I'm buying into, and in our case, as a lender, who are we lending to and what are we lending on? I think that's the really important thing. So you'd want to look closely at what our underwriting criteria is and make sure you're comfortable with the risks that we're taking on as a fund. So what's our loan to value up front and as repaired, and then what kind of pricing do we have in there? And obviously one of the really important things is what is the experience of the people behind the fund.
Sure.
And to Anthony's point earlier, I think you can have a little bit of a good comfort level with our team because we have such experience. To myself and Mark on the financial risk side, and Christian and Jared. On the conventional and operational side and sales side, and then guys like you, Anthony, and Cory that are on our team that have experience in realty and doing multifamily homes and things of that nature. But yeah, so those are the things I'd be focusing on. What type of risk, and I always like to look at a fund and go, in a really distressed scenario, what happens? Kind of what your question was earlier, Cory. And if you look at our fund across our whole portfolio, we're less than a 60% loan to as repaired value. So you can see there's a pretty big cushion of a roughly 40% if things go a little bad. We have a cushion to work through these loans, and our collateral should support us.
So just to piggyback that a little bit, if you met a new investor who was interested in possibly putting money into a fund, what are some questions that if they asked you, you would say, well, this person obviously did their homework, they're asking all the right questions. What are some of those questions that they should be asking aside from what you just mentioned? Anything else?
Yeah, I mean, again, how did they get their money out of the fund? Is there a gate? When we do have a 20% gate, in other words, if more than 20% of our investors wanted their money out at one time, in order to protect everybody, we are able to stop that and roll it into the next withdrawal period so that we can kind of do an orderly unwind.
Sure.
Kind of an important thing. So, questions of that nature about the actual looking closely at the terms. I would always want to make sure is that the principals, the people that run the fund, do they have their own money in the fund?
Right.
And we do. We started the fund pretty much entirely with principals' money. The owners put our own money to get started, and we've been slowly raising money from outside investors. But that's so important because I wouldn't want to invest in a fund someone that's running it is not comfortable enough putting their own money in it.
Sure, you want them to have skin in the game as well.
Yeah, absolutely. So I would definitely always ask that question. Do you have your money in it, and how much do you have as a percentage of the fund? We have probably still in excess of 50% of the fund is our own money,
right?
The owners. So that'll hopefully probably lower over time as we continue to raise extra capital, but we'll always be in the fund.
Right along with the investor.
Yeah, right along, side by side with the investors, absolutely.
One thing that's come up lately is interest rates and interest rate risk and things like that, as rates kind of have ticked up this year a little bit. I know there's not a big correlation between what we're lending at in the hard money space and what the broader economy's interest rates are. Do you want to talk about maybe that relationship and if you see that affecting what we're doing here?
Yeah, absolutely. I do get that question a lot as well. And the way I answer that is, the way we look at it is it's a kind of a spread business, right? We're looking to make a spread between where we're originating loans and where we're going to go out and then at some point sell out of the loans in the secondary market. So you would think as long as we can maintain a spread on where we originate and where we're selling, I think we're going to be good. And then to your point, I don't think, the fixed flip space is all that sensitive to small moves in the interest rate market that you would on the, bank and lending and conventional lending side. So I'm not overly concerned unless you get some really dramatic or drastic moves, I think. And in some ways, with rates increasing, the loans we're doing look better on a relative basis, even in a raising
100%.
In a raising rate environment, I would say.
Well, yeah, I find that interesting because as some of our borrowers listening know, we're anywhere from 9 to 12% on the hard money side, and we have rental product at 7 to 9%.
Yeah.
And then you have conventional rates creeping up to 5%.
Yes,
exactly. Or over 5%.
Yeah.
And just speaking from a multifamily perspective, I know one of the metrics everybody looks at is the 10-year Treasury, which you kind of use to track where rates are going, and that's been creeping up higher and higher. I think it's at 3 now almost. And so that's really put like compression on cap rates and stuff, and so it creates some uncertainty. But we really haven't felt that in the hard money space. And to your point, it makes our loans look a little bit more attractive if rates generally are higher, but we're kind of in the same spot.
Yeah, we're seeing compression in our rates a little bit in a rising rate environment, which is a little odd, but it's because of all the money that's coming into the space. It was a very underserved market for a long time, but you're starting to get more efficiencies in this space with more and more money coming into it. So you're seeing compression, which is good for our borrowers. And as long as a fund, we're getting that lower pass through to the investors that are out there, then we're fine.
And one thing I think we do a good job of is staying disciplined in terms of we make sure we have our good spreads and our good margins, and we don't, like we said earlier, we don't put borrowers in bad situations where we can just want to do a loan and put them in a spot where we know that at best case scenario they're going to make a very little bit of money. We've done a really good job, I think, of making sure our borrowers have good experiences, and then we put them in the best position for success.
Yeah, that's correct. And we try to be aggressive on the lending side to people that are, much more experienced, have done a lot of these type of things where we're, like Cory's saying, at 9% or 8 and change even to our really experienced borrowers, because we can then go out and sell them at a better pass-through rate out in the market. So it allows us, we're trying to pass it through to our borrowers wherever we can.
I don't know about you, Cory, but I can't tell you how many times we've had borrowers from, name your national hard money lender, that somewhere out in California, they maybe talk to a different person every single time they call them. They have a terrible experience, and they end up coming to First Equity, and they realize, well, not only are our rates just as competitive or better, but there's a personal touch, and they can build a relationship, and I think that goes a long way, and which is why I think we've been very successful, because we have a lot of repeat clients who have had good experiences and want to do more deals with us.
Yeah, absolutely.
Yeah, no, I think you're right, absolutely.
Anything else?
Well, before we switch, I wanted to switch gears into maybe in general other places of passive investing in real estate. But I know you mentioned I want to come back to investing in IRA into a fund. I guess real briefly, how would that work?
It's fairly easy. We've gotten approved. What you have to do is a lot of people's IRA provider, they may not allow you to self-direct. So sometimes you have to take your money and roll it over into a custodian that is able to self-direct the money for you. So I know one of the ones we use is Midland. There's a lot of them out there. If you just, it's better to get it referred to someone so you know that they're a good, custodian. But you would roll your money into that. You would get it approved. You tell them what the investment is, and then you could self-direct the money into our fund.
I think it's a good option for a lot of people because they might not have that much cash liquid, but they have a big retirement account that they might be kind of weary of the stock market at this point, and they want to look for some other outlets. And they don't even know that they can do this with their old 401ks rolled over to an IRA with an appropriate custodian, and you could be involved in this.
You're absolutely right, because a lot of people just aren't even aware of this. Like one of my friends is a super, pretty sophisticated guy working up on Wall Street at Deutsche Bank, and we're chatting about him investing. And I guess I didn't mention it early on, but towards the end, he's thinking about it. And when I mentioned, he's like, "Oh, I can put my IRA money in this? I didn't know that." And once he figured that out, he's like, "Definitely, I'm gonna be in on that." But a guy that's very sophisticated in the financial markets, people just aren't aware of it.
They just think
it's like an education.
They think you're stuck with bonds and mutual funds, and they don't know.
Yeah, I didn't. When I first found out, I found it really interesting that you could self-direct into your own type of funds or real estate.
You almost have to second guess it. Like
I can.
Are you sure? Yeah.
Yeah, but, it's great.
You absolutely
it's such a good way to, such a good vehicle to do if you can take advantage of it if you can.
So that's probably
the only thing I should just say is you got to be, if it's 401k or if it's some sort of defined contribution.
It would have to be an older one that you're rolling over to an IRA, right?
Yeah, that gets a little tricky. We could potentially do it, but just be aware that that's not as simple as
IRA
like traditional
would be the best case scenario.
Yeah, exactly. Yep.
Okay.
IRA, yep.
Anything else there, Cory?
Not much. Is there any limitation on like a Roth IRA? I know it's structured a little bit different in terms of taxes.
No, you can do Roth IRA. You can
change much.
Yeah. I mean, obviously, I tell everybody to talk to their accountant and make sure. I can't give them advice as to exactly, but yes, you can do Roth IRA. Yeah. Yep. Exactly.
If somebody is interested in the First Equity Fund in particular, what's a good way for them to contact you?
Yeah, they could probably just reach out to me directly. Call the office here and ask for me at the regular line 732-359-7800. I'm extension 225, or just send me an email.
Okay.
And I don't know if you guys post this contact.
We'll post it on the screen.
Yeah, so if anybody's watching and if they want to reach out, they could also reach out through you guys, and you guys can put them in touch with me.
Sure.
If it's people that you guys have a relationship with.
Okay. Well, thank you. Appreciate it.
Yeah, thanks, guys. It was a lot of fun. I finally made
a nice angle
to get on the podcast.
Yeah.
And I appreciate it. It was fun having this discussion.
All right. I guess we're out.
That's it.
Thank you.
Thanks, guys.